I'll introduce our next segment, which will be headed up by Bill Rhodes, our advisory council member, and known to all of us. He's got a great broad experience, and as you know, he is known as, particularly to himself, as banker for the world. Bill, why don't you come up here, get our panel together, and introduce them. Bill? And the panel, please. Are we all here? Good. Thank you.
They were all waiting in the wings.
They're there, good.
You're there. Yeah. And yeah, just take Luis Alberto.
How are you? Hi, how are you?
Thank
you very much.
I'm going to start up here. Thank you, Dick, for giving us a history of the Bretton Woods system and mentioning the very important compendium that we're putting together. I was involved in one for 50 and one for 70 years, but I think this one is going to be, as Dick indicated, very special. We have a great panel. We don't have a lot of time because I know there'll be a lot of questions. First of all, we have David Lipton, who everyone knows here is the first Deputy Managing Director of the International Monetary Fund, and I thank you for hosting us here, David, today. Clare Woodman, who's been with us before, who's the Global Chief Operating Officer of Morgan Stanley International. From London, our good friend, Alberto Moreno, who's been so helpful to us over the years, and Dr. Joachim van Amsberg, who is the Vice President of the Asian Infrastructure Investment Bank, which is starting to play a very important role in Asia. And since we had discussions on the One Belt, One Road, I'm sure we'll hear something from him in that regard. I think when we take a look at the world today, we're looking at economic conditions that look much brighter than we've seen in the past. And we just saw the IMF recent report underlining that. But in saying that, we still face a lot of problems, such as looming trade wars, rising debt levels, rising geopolitical tensions. All we have to do is mention Middle East, Korea as an example, a vast infrastructure gap, and potential for regulatory race to the bottom. We'll be hearing more about regulation with our last speaker today. I guess against this backdrop, what we want to hear from our panel is how countries can capitalize on the momentum of the improving economy while navigating global and regional risks. I think we have to remember it was only 9 years ago when we had this conference that we were talking about rearranging the deck chairs on the Titanic. So it's taken a long time, but we certainly have come a long way. But we can't take this growth for granted, and we always have the possible downsides, slowdowns. We're 9 years into basically coming back from the Great Recession, and so this is a very important, I think, moment for us. I have a general question for everyone to start off with, and depending on time, I go back to everybody. But I think the question is how we should be, and I'd ask each of our panelists to start off with that, and then I'll go back for individual questions, how they view this particular scenario that I've outlined in their areas, and for that matter, worldwide as you see it. And we'll start with you, David.
Thank you, Bill. First, let me say thank you to the Bretton Woods Committee for having this event and for inviting me here. It's been great over the years to have the Bretton Woods Committee so strongly supporting our institutions. Listening to the talk about Bretton Woods 75, I realized I first worked at the IMF in 1981, so I've been one way or another working on IMF issues for more than half of the 70-plus years and seen a lot of what's happened here, and also the long-standing support from all of you. I think it's a good moment in the global economy. As we like to say, the sun is shining. Our message this week to people is that it's a good time to fix the roof while the sun is shining. You know, since I came back to the fund in 2011, year in, year out, we found that our forecasts, our previous forecasts had to be downgraded, a sequence of basically bad news surprises. But the last 3 times before this one, we've been upgrading our forecasts. So the metric of our errors is basically the direction of news, of unexpected results. And I think we've seen strengthening of the global economy, broadening of the global economy, and in particular, finally, and of interest to all of you, trade growing more rapidly than GDP after many years where that was not the case. And I think that's because investment is strengthening, and investment involves a lot of importation. You know, I think this is not just advanced economies recovering, but also broadly across emerging market countries. There are a range of different circumstances, obviously, and some of the commodity exporting countries are still adjusting to the fact that what they had presumed about commodity prices and their incomes was turned out to be too high. But I think we're in a good period, and for reasons we can go into as we go along, I think the future may not be quite as good as today, so it's a good time to fix the roof.
Alberto?
Well, thank you very much, and thank you for inviting me here to the Bretton Woods Committee, and of course, David and you, Bill, have devoted a lot of your time to fixing the roof in Latin America when it was truly leaking. But today, well, of course, we're in a very different moment. As you know very well, I think the whole macroeconomic situation that, as David was correctly saying, helps all ships rise. And what that means in terms of our work in Latin America is really moving ahead on many of the structural reforms that are needed. We went from having almost 7 countries in recession to having only 1 now, which is the case of Venezuela, a country you know well, Bill. But at the same time, our biggest challenge, and to follow on something David was saying, is where do you get more growth? And that, to me, is the larger question that we have in Latin America. And to get more growth, clearly, the answer lies partly in productivity. And behind that is a whole set of structural reforms that are still pending. Reforms associated with how we invest in human capital, the kind of quality of how we do our investment, how we manage our savings rate and how we increase it, but equally how we diversify our export base. We continue to be largely like we were 20 years ago, exporting fundamentally 5 or 8 commodities, of which, of course, Latin America still has a very large market share. But we got to learn a lot from countries like Canada and countries like Australia and others who were able to, around some basic commodities, develop, especially into the services area. And this is, of course, the big challenge today for Latin America. Growth still is below what it should be. This year, according to the latest numbers, is going to be close to 2%, probably closer to 3% next year. But there's still a lot of shocks that are possible in the horizon, like you were mentioning, especially what happens with the interest rates in the United States and other countries. But at the same time, before, as you know, in the days you spent time in Latin America, most of our shocks came through the financial channel or our trade channel. The larger shocks for the future are going to be associated with the intolerance around issues like corruption, which I think is the huge issue today in Latin America. I just came back from the Summit of the Americas, where both the private sector and governments were very much focused on what to do around the issues of corruption. And then, even though we have inequality, have always had inequality, the patience for people to have inequality of opportunity is a very big issue. And I think that requires a very different kind of mobilization in our society. So these are more of the challenges that I see going forward.
I think your comment on corruption is well taken at this point. I know the IMF is talking about a program there, the World Bank is, and I think it's becoming more and more of a concern. let me turn to Clare, and then we'll move on to Joachim, and then I'll go back to you with specific questions. Clare?
Well, thank you for letting me in, because I've never worked for the IMF, and I seem to have managed to get on a panel 2 years running, so thank you. I work for a US global bank with a very cross-border business, so we like to think of ourselves as being there as an intermediary to help repair the roof. Yes, very much consensus around economic growth and positive conditions. Clients and investor sentiment is extremely positive around the global economy, corporate earnings. We've seen, rising equity markets since 2009, and client sentiment is that that's broadly continuing. And hence you've seen, the large US banks all report first quarter earnings, and you've really seen a part of what's driven those results has been real client activity that the banks have facilitated. So what's on the client's mind at this stage, Bill, is scanning the horizon. The big debate that we're having with clients and investors is how long has the business cycle got to run? What are the potential risks out there that might emerge, and where are the sources of those risks? And you raised trade tensions. Is the concern that trade tensions escalates to something that basically becomes an impediment or a barrier to the free flow of capital and goods and services? Our economists' view is that this is manageable, and this is really, the end game is really a process of negotiation, and this, really de-escalates. The second concern is which, clients find hard to quantify, and the markets respond very quickly to, is geopolitical tensions, and you saw the markets react very quickly recently with respect to Syria and North Korea. But more pointedly, our economists, and we put a piece out yesterday, was really the focus, and I think this has come out through the IMF's work, is around financial stability risks as potential sources that just might cause, this extension of the business cycle to contract at some point in the future. The IMF and the Federal Reserve and Basel have done extensive research on this, but there's certainly indicators around leverage, etc., excessive leverage, the size of debt in the economy at the moment that really need to be watched for sources of risk. But, if we see, continued investment in technology and innovation, which really helps productivity, there may well be a positive and a bright side to this.
Thank you. Joachim?
Thank you for having me here. You asked what can countries do to benefit from the advantageous situation. In a word, I would say invest. What can they do to protect themselves from the risks? In 2 words, I would say invest well. So let me drill down a little bit into both aspects. Invest because our member countries, and these are primarily the Asian emerging and developing markets, face a unique opportunity of ample available capital at low cost, still low cost. That is quite unique if you look historically, and incredible investment opportunities at good returns. So if you look at the big regional trends from urbanization to infrastructure gaps, yes, infrastructure gaps are a hindrance to growth, but they're also an investment opportunity and mean that there's plenty of projects that can be invested in at good and high returns. If you look at trade, while parts of the region are well integrated, there's huge opportunity for expanding trade, for example, between South and East Asia, just to give one dimension of growth opportunities. And if you even look at potential challenges, climate change, technological change, all those present investment opportunities. So in sum, the combination of ample available capital and investment opportunities creates a big opportunity to invest. Now, we work in infrastructure, and we see the paradox or the puzzle that despite capital available and capital needed, very little actually flows into emerging country infrastructure. And that then leads to the policy agenda for improving regulatory environment, improving project preparation, and improving the structuring of infrastructure projects for institutional investors, and an agenda that the multilaterals have been working on for years and I think are making good progress. And we were set up to actually help move that agenda forward together with our peers. So the prospects in the region, I think, are bright unless something goes wrong. And of course, things do go wrong. And so what can go wrong, and how do countries prepare themselves for that? Debt could go wrong. Ample availability of capital means there's always the risk of excessive debt. This is where I said invest well. The answer to that is careful scrutiny of projects. We are a bank, so we have very strict criteria for the projects we invest in, because it is ultimately the return to those debt finance investments that will determine whether debt leads to disturbance or leads to growth. So that's one dimension of risks. Social tension, of course, but again here, the right policies are those that maintain growth and ensure broad-based benefits from growth. Poor policies could derail the scenario. Of course, we're looking at a region that's half the world, so there's a whole range of different policy choices that could go wrong. But overall, I think in the region, there's a pretty strong consensus across the political spectrum on sound economic policies. So overall, I think we are very optimistic about development in the region, and yet encourage our member countries to, as others said, fix the roof and make sure they're prepared for disturbance that could come from anywhere in the world.
Thank you. I know, David, you and the managing director have talked quite a bit recently about your concerns on what's going on with the trade tensions in the world. And the other thing I wanted to ask you about, something which you're an expert on. We first met, how many years ago? 30 years ago, working on East and Central Europe when you were helping turn around Poland and the debt problems there. The growing indebtedness we see in the world. I mean, I can just think of China, and you might want to comment first on the trade tensions, which I think are really concerning the world markets and the potential, unfortunate potential there, and maybe that you might want to get into the indebtedness area.
You know, I started out with the baseline, and the baseline is good, but I think it's our job to think about what pushes us off the baseline. First, of course, we're in a cyclically a strong point, and countries are growing more rapidly than potential. And at some point, that's got to turn. But moreover, the policies that are right now have been driving recovery and sustaining recovery include a lot of monetary accommodation. And there's been a lot of liquidity, a lot of credit creation. On top of a lot of the sovereign debt that was incurred as part of the cleaning up of the global financial crisis. So debt is very high. We've been talking about the fact that global debt, public and private, is $164 trillion, roughly twice global GDP, and that's up about 40 percentage points since before the global financial crisis, and a large proportion of that increase, 40% of that, is from China. I think the monetary accommodation and loose financial conditions creates a climate in which that's going to continue rather than stop. So I think it's very important that countries, especially where there's high sovereign indebtedness, take policy steps gradually so that they don't hinder the recovery, to get debt trajectories going downward once again. That we, as an institution, help members individually, because they'll all be in different situations. Some can overcome this problem by adjustment. Some will need debt treatment. We are seeing, unfortunately, some low-income countries, especially the commodity exporters, whose circumstances, as I mentioned before, are worse now, falling again into debt difficulties. And we face the new challenge that their creditors are not necessarily the traditional Paris Club creditors. It may be a group of creditors that aren't accustomed to dealing with the problem of how the IMF goes forward when it needs financial assurances, and debt operations are part of that picture. So I think debt's one of the subjects that's important and could derail recovery for some. The other, of course, is trade. It would be very unfortunate for trade tensions to derail recovery. It would be very ironic since, right, as I mentioned, trade is helping drive recovery right now, and just in a moment where trade is a positive for it to turn to a negative. We know trade has been an important part of the driver of global growth and of the catching up of low-income and developing countries for years, and it's important to protect that, and rather to be looking more for ways to increase market access rather than to put in place new impediments. Now, that said, I think it's fair and understandable that countries where there's been a lot of dislocation, and the US is one, draw attention to some unfair trade practices around the world. And I think countries who've, whether it's been WTO legal or illegal, or inside the rules or outside the rules, countries that have had trade practices that really aren't fair, if they want globalization to endure, they should take a look at their own practices, and everyone needs to be contributing to a free and fair trade, greater market access rather than lesser. At the same time, the United States, I think, should not be trying to achieve its aims through the imposition of trade barriers, but rather through cooperative and internationally broad approaches to this. I think, for example, there's an awful lot of concern around the world about China's trade practices, and it is ironic if that's not spoken about, and that really should be part of trying to drive a good discussion and a good conclusion to the disagreements that exist right now.
How do you see the role of the IFFIs, but particularly the International Monetary Fund, in trying to advise countries in this area? Because the last thing we need is to get into a trade war reminiscent of Smoot-Hawley, et cetera. And you know, the IMF, whenever there's a situation that's very difficult, people tend to look to the IMF to help in this area.
Well, we're trying to lead a discussion here, among the whole membership, to stress the point that there really are joint interests in globalization enduring. China has benefited from it. That's why China could never have accomplished what it has so far without deep interconnectedness, and won't continue to proceed without it. The rest of the developing world is counting on interconnectedness. With all of the new technologies and the need for, on the part of developing countries and emerging market countries, to have all of that technology disseminated to them, we need globalization to endure. So there's a two-sided interest in this. The advanced economies have been concerned about the dislocations that come from globalization and from technological change. We need for people really across the world to believe that the whole system is free and fair, and so I think it's it's our job to try to bring people together behind a common vision of globalization in everyone's interest.
Thank you. Luis Alberto, you have worked very hard and done a lot in the area of infrastructure, and there's no area of the world, maybe Africa, that needs it more than Latin America. I mean, take the case of Brazil, so many countries. You might want to comment on that, but I can't let you go without asking you about the electoral process this year in Latin America, because you have elections for president in the two largest countries in Latin America, Brazil and Mexico, which will have a big impact not only on Latin America, but globally, and particularly when here we're struggling trying to get NAFTA done. And so maybe I've thrown you a lot there, but maybe if you could comment on some of that.
Well, first of all, on the infrastructure question, you're correct, Bill, in that we have to double the amount of investment that we do in infrastructure. There's simply no way to do that simply out of public spending. We've worked a lot, as Joachim was mentioning, on the ways that we can do far more in the way of public-private partnerships. This is a big theme of Argentina in the G20, and the notion that you can move in the direction of having infrastructure as an asset class. But fundamentally, is how do you balance risks? And this is the biggest issue that you have, not only the regulatory risk, the financial risks associated with local currency, the way that you can mitigate some of those foreign exchange risks, and then some of the regulatory risk associated with PPPs. And we've made some good progress on this. I think, interestingly enough, and this is very much of a Bretton Woods kind of discussion, but when you look at our balance sheets, the reality is that we collectively as multilateral development banks do maybe about 4% of our total lending in the way of guarantees. And those guarantees help mobilize around 40% in terms of additional resources. And so the question is, how are we smarter in getting a guarantee mechanism such that we don't have to book them as loans, which is the case in our accounting, but rather as guarantees in a MIGA type structure, but taking it even deeper. And I think that's something that we all collectively have to think through. One of the things that we did at the IDB was to consolidate all of our private sector windows into one, put more capital, and today we're doing about $3 billion a year in lending, largely infrastructure, and mobilizing double that amount. So these are the kinds of things that we should think as development institutions, how we can become a platform to mobilize far more resources. In terms of the elections, it's impossible always to predict. Let me begin at the outset to say this. In the Summit of the Americas this past week, what I found was a very different Latin America, much more forward-looking. You know well that we love to look, spend all of our time thinking of what happened in the past. And that's what makes us so different from Asia, which they're always putting all the emphasis on the future. But here the agenda was around issues of corruption, issues of how do we deepen our own trade integration. Latin America only does about anywhere from 18 to 20% of our trade is within the region. What is missing? I think there's other elements. How do we do better, for instance, our integration in energy? It's not about building more dams or more renewable sources. It's how do you do interconnection better? And that has all to do how you share grids, things like that. How do you do things like passports of pension funds? We have $700 billion sitting in private pension funds in Latin America. So these are some of the challenges in terms of integration. I think that's the agenda going forward. Having said that, what I see in Brazil is more of a, it's still a long ways to go. It's in October, but that's probably not unlike what you had in December before your election. A lot of candidates out there, but I see perhaps a convergence towards the center, and I think this is a good thing. A lot of what I see happening in Brazil, as you know well, is that many of the issues that were not discussed in Brazil are discussed every day. Everybody talks about pension reform. I think that's the first step to begin to do a pension reform. Probably the traffic cannot bear it right now, but it's something that is going to be taken on. So I think that you will find that Mexico is harder to read, at least right now. The election is in July. In Colombia, for instance, for a while there, we thought we were going to have a very left-of-center candidate, and today it will be somebody who actually worked with me very closely and learned everything he learned at the IDB, a young guy, very good. So look, at the end, maybe because I'm Colombian, I'm optimistic, but I think I see the region moving in the right direction and with the kind of leadership that we need for this moment.
Thank you very much. Clare, we couldn't let you go without saying something on Brexit and how you see
that was going to happen.
And how you see London surviving, prospering as an international financial center with all of the give and take. I mean, you can't pick up a newspaper, particularly the Financial Times, any particular day when they don't talk about what are the possibilities or lack thereof of London continuing as a major international financial center.
Well, thank you for that one, Bill. Because I wish I had a lot of detail to actually talk about, but all I can talk about is kind of where we're at. And firstly, just a point about, and this is something that we talk a lot with clients and investors about transition. So there was an agreement between the UK and the EU about transition arrangements being in place broadly till December 2020. There is still a lot to do to actually legally finalise the transition and the withdrawal agreement. It's got to get finalised. There's some and this is an agreement not about what the nature of the trade arrangements and access will look like. This is actually just about what the Brexit process is about. And within that, there are some still very politically sensitive issues for the UK and Ireland. The Irish border question is not yet resolved. So what needs to happen? The agreement needs to be finalised and then it needs to be ratified. It will probably be relatively straightforward through the EU Parliament, but it's got to get through the UK Parliament yet, and there will be a very active discussion around it. So I think we're optimistic if we think that that agreement gets finalised by the autumn. The intention is that it gets ratified by the first quarter of 2019. That's about the process. It doesn't tell us anything about what we're transitioning to. And that's what businesses who are, based in London and have based their operations in London because London was a great gateway to Europe, that's what they need to know. They need to know what's the certainty of the access arrangements that they'll have to access EU markets, keeping their businesses in London. And so most firms have got their contingency plans in place. They're essentially to make sure that firms can continue to service EU clients and EU activity, and will largely mean that the regulated activity that you have to conduct in EU 27 will be substantially, they've got the resources there in place. But as I said, we still don't know what we're transitioning to. Yes, there's a lot of coverage in the news on this, but we're still short on actual detail about the access arrangements. What's key for very regulated businesses is not just the nature of the access arrangements, but the scope and extent of regulatory cooperation. So for financial services, the commitment of UK and EU regulators to cooperate and collaborate is absolutely key. I think they're very thoughtful, and we've had some positive signs on that, but that needs to go in conjunction with, a good open access arrangement. We'd sort of like the status quo, basically, Bill.
That I understand. Thank you very much. Joachim, two questions I'd like to ask you. One, obviously, your institution is very much involved in infrastructure, and the One Belt, One Road, the Silk Road, is the largest single infrastructure project probably in world history as we look at it today. The other thing is, in China, we've seen comments by President Xi Jinping and others in the leadership about opening up the financial system. And David commented on some of the practices where the Chinese have not wanted to open up before. And they seem now prepared to, particularly in the financial system and maybe elsewhere. Every day we pick up the paper and there's some announcement that they're going to open up more and make better conditions in the automobile industry. But one of the real drivers here is going to be the financial system. And you've just had a realignment. For instance, in the People's Bank of China, Zhou Xiaoshuan is gone. Yi Gang, who was his deputy, is there. You've had changes with Liu as the senior economic person. And then the friend of many of us here, Wang Qishan, is now the vice president of China. And all of these people have sort of mentorees of Zhu Rongji, who was a great liberalizer in modern Chinese history. So I'm giving you a lot to answer here. And after that, we're going to open up for questions because this is such a great panel. And I don't want to be accused of not giving people the opportunity to question this great panel. Joachim?
Thank you. Well, you mentioned three initiatives that are loosely tied together by China taking a bigger role on the global stage in the global economy. So one, the Belt and Road Initiative, two, the creation of AIB, the institution I work for, and then three, financial sector opening. Let me talk about each of those three briefly. I mean, Belt and Road is an initiative, as the title says, and I think it's very important to keep in mind that it's an initiative, which means it's more of a label and a slogan than a project or a program. It is certainly not an institution. And I think Belt and Road initiative has gotten a lot of traction, particularly probably because at the same time as Belt and Road went on the road, there has been doubt from other countries about the benefits of openness in trade, and Belt and Road is very proactively promoting an open world that benefits from trade, just like China and other Asian countries have done for decades. So Belt and Road, I think, has become a motivator for countries to pursue investment plans, infrastructure in particular, but not only infrastructure. And it could become, if it is successful, a coordinator, in particular for investments that require cross-country coordination. Because many of these trade corridors do require very carefully coordinated investments among many countries, and that's where you need coordination. So in that sense, I think Belt and Road has become a very welcome initiative, particularly with the prospect of investments following. But of course, the fact that it's an initiative also means there are really no clear rules, and that I think is also part of why some quarters are worried about Belt and Road, because there are no particular rules or standards involved with it, because it is just an initiative. So one actually has to look beneath the level of the initiative to the institutions that are involved with implementing projects. And these are by and large countries themselves and financial institutions. Of course, the big Chinese policy banks, but equally the multilateral development banks. And we are just one of the multilateral development banks who will invest in the space of Belt and Road because there will be good projects. We as AIB will not invest in a project just because it is Belt and Road. We invest in a project if it has good returns and if it is environmentally and socially sound and otherwise a high quality project. Because we, as AIB, very different from an initiative, are a bank. So we have a balance sheet, we have a legal charter, and we have firm rules and policies that we have to work by. I mean, our bank has grown from 57 founding members to now 85 approved members. And we're little by little building up a bank that operates under clear multilateral governance rules and very clear project standards. So we're very pleased with how the build-up has gone, and I think the growing membership is sort of tribute to the growing confidence that AIB is truly a multilaterally governed institution. On the third initiative, the opening up of China's financial sector, I mean, just a few words. I mean, in one way, certainly the announcements and the increased clarity about timetable and the nature of opening up the financial sector to foreign investments in particular is welcome and is positive. And I'm sure will in particular be seen positively by the financial sector. But I also wouldn't overrate that particular announcement. I think there are reasons why the impact on China and on the region will be limited. One is that I think Chinese leadership will continue to put predominant emphasis on economic stability and control of financial risks, which means that capital account controls will in some form or another continue to exist and will have an influence on and will have a limiting factor on how much financial sector opening can actually achieve. Secondly, China is not an underdeveloped financial market. So the opening to foreign investment is not leading to the jump that happens in an underbanked country where you allow the foreign banking sector to enter. So again, therefore, I would not overestimate the impact that could come. I would think that other developments are probably bigger and more important for the region, other developments coming out of China. I think the changing trade composition related to the increasing cost of producing in China is really, really important for other Asian economies' development prospects. I think China's outward investment is quite important in terms of creating links within the region that are new. Even in the financial sector, if you look at, let's say, fintech investments from China into Southeast Asia, they would suggest that Southeast Asia will be banked much more like China in the future than like the West. And that has important implications that I think are important to recognize.
Thank you very much. So we've got 20 minutes left, and I know there are a lot of questions, so I have plenty more questions for our panel, but I wanted to open it up to the audience. And so if you can just state your name, what company you represent, if you do, The gentleman right there. You. Yes.
Thank you very much, Bill. Mahesh Kotecha, Structured
You go next. That's all.
Credit
Go on.
International. Sorry about that. I didn't mean to cut you off. My question really is about infrastructure. Senator Moreno mentioned something very, very important. Two things. One, $700 billion of pension fund money sitting idly by. And of course, there's in the US even larger amounts, 10 times. Globally, there's a lot of underinvested funds in low investment returns. At the same time, you also mentioned the capacity. I think others have talked about PPPs not being sufficient, being necessary for investments in infrastructure. There was a great construct in Asia, which I had the opportunity to found, called Asia Limited. It was a financial guarantee company rated single A. It was a guarantor like yours, like you can do, but it failed. And the US has had monolines also that failed. But there's been some successes there. So I would like to ask this question. In the US, monolines guaranteed $3 trillion of debt without a default before the financial crisis. It was for infrastructure. It was US infrastructure. There is a great precedent there for international infrastructure. I'd like to ask you, what can the multilaterals do to really go back to the original founding raison d'etre for multilaterals in the Bretton Woods period, which was to make guarantees, not loans. This has been lost. I'd like to ask whether this can be rejuvenated.
Well, real quick, and I'm sure Joachim will have other ideas on that. When the financial crisis hit, we had to go into a number of countries and replace those monolines. But basically for us, they are booked, as I was saying earlier, as guarantees. So we do need that MIGA type instrument in today's age, where you can do not only public sector type guarantees, but private sector type guarantees, where you basically can look at the different risks and begin to have a way to price them differently. And we're going through that internal discussion and with our shareholders to see how we can set up something like this. But I totally agree with you. To me, that's one of the missing links. And when you go and talk to all the big pension funds, people who have appetite for long-term type of investments, that's the one missing thing that I find that has prevented us from being able to crowd in far more private sector money.
Okay.
I mean, our bank was set up to address this paradox of funds are available and need for the funds is there, but the two don't connect. And more, I mean, you mentioned the success of US infrastructure investments. Actually, if you look at the data, emerging country infrastructure is not more risky than advanced economies infrastructure. The empirical data is very, very clear. So the paradox is even starker. We sort of take three approaches to this. The first is the very traditional MDB approach, which is on balance sheet. We let institutional investors buy our bonds that we invest in emerging country infrastructure. That's the 70-year-old proven model. The second approach is co-investment and guarantees. With our participation, we give private co-investors the comfort that in particular political risks are managed and reduced, and therefore give them the comfort to invest. The third, and I think most promising but also most challenging, is kind of really find instruments that open new markets toward the asset class that Alberto talked about. Just an example. Institutional investors are more likely to buy assets backed by operational cash flow generating assets rather than greenfield assets with a lot of construction risk. So we work on initiatives to take the assets of commercial banks, operating assets of commercial banks, repackage them, securitize them, sell them to institutional investors to let the commercial banks go back to do what they're best at, which is originating new projects. And we will be providing some credit enhancement that will make these newly generated securities attractive enough for private institutional investors to come in and buy them. Just one example of a huge agenda.
Very good.
Just one word on the subject of guarantees. I mean, I won't comment on, I think there's a genuine question of how to connect the funds with good projects. But your question, I think, suggests that there's an economic issue here. The monolines failed when it turned out that many of the things they guaranteed were correlated. And the question that has been raised about whether you can book a guarantee differently than a loan depends on, if you make 3 guarantees and they're big and they're all correlated, you got to book them like a loan. And so if this is where I think the MDB's thinking collaboratively about sharing their balance sheets, having more diversified portfolios, perhaps keeping the guarantees to modest size. There is, though, the irreducible problem that in certain circumstances, say commodity price decline that affects a large swath of emerging market and developing countries, or global downturn and so on and so forth. When the correlation shows up, the problem shows up.
Thank you very much. I don't know, Claire, if you'd like to make any comment.
No, I don't think there's any much more to add to what's been
Right.
said.
One of the things you might want to do, the next question is, if you want to refer this to the whole panel or just to one individual. Yes. My Sikh friend there, I did see you, but.
Thanks. My name is Vikranjeet Singh. I'm from New Rules for Global Finance. My question is to you. You mentioned China making fintech investments into Southeast Asia.
Can
Everyone hear me?
Speak
No, I
into it.
don't think they can.
Just tell
Speak
them
more
speak
into
it.
that. I don't think they could
on.
hear you.
Yeah, it is on.
Just hold it closer, it's on.
Closer.
There you go.
Yeah, closer.
My question to you is about China making a lot of fintech investments into Southeast Asia and how that might change how Southeast Asia would bank in the future. If you could please elaborate on that. Thank you.
I guess that's to you, Joachim.
Just a quick comment. When I moved to China 2 years ago, people still had cash in their wallets. Today they don't. I don't carry cash in China because you have your smart phone and you pay with WeChat and Alipay. Now it happens that the owners of those two companies are very significantly investing in similar ventures across Southeast Asia. If you look at the speed of spread of those technologies in China, where in 2 years payment systems have totally been transformed, it may not be as fast in other countries, but just brace yourself for the different kind of banking and payment system that you will probably see across Southeast Asia in 2-3 years, if not earlier.
Right. David?
I think this is a tremendous area for innovation, and we're seeing innovations in China and now spreading to South Asia and Southeast Asia that are in many respects ahead of what's happening in the United States and Europe. Some of it has the promise of promoting inclusion, overcoming remoteness. People who don't live anywhere near a bank can not only buy and sell things, but they can deposit money and they can borrow money and they can go into business, and that's a huge benefit. I'm sure, though, that as this spreads, questions will arise about the impact of these platforms on existing banks, on existing institutions. Questions will arise about proper supervision and regulation. The Chinese themselves are very focused on this, and they will probably be the first to have to strike the balance between encouraging and enabling innovation that'll be really good for people and dealing with the byproducts, issues around financial stability risk, privacy of data, the security of payment systems, whether there's operational risk in China. One entity conducts a very large fraction of all of the payments in the country. So if it were to have a glitch, it would be very significant. So I think we all need to be focused on the possibilities and enabling them, also watching out for the risks. And I think China and Southeast Asia are probably going to be the place where this first plays out.
I think we're in the midst of a revolution here. And we don't know where it's going or how long it's going to take, but it is a revolution without a doubt. Yes, over here. Yes.
My question is for David Lipton. You mentioned a huge growth in debt over the past period and unprecedented levels. At some point, and we heard President Kim earlier today talk about the elimination of muscle jobs and then the elimination of certain kinds of knowledge jobs. We've heard a lot of talk about perhaps national incomes, that sort of thing. Do we need to start to look at a different model for taxation for funding governments?
I'm not sure. I think that the question of domestic resource mobilization and the efficiencies and distortions of tax systems and the international harmonization of tax systems is a subject we're going to have to be on. There are some parts of the world where revenues are just too low a fraction of GDP to be able to both service your debt and pay for needed things, health, education, and infrastructure. There are countries where the tax systems are really, they raise enough revenue, but they're really inadequate and need to be reconfigured. In advanced economies, we've favored corporate tax reform in the United States for many years. One can quibble about exactly the features and so on and so forth. But there's also the risk that different corporate approaches to corporate taxation in different countries lead to a kind of deharmonization that's unhelpful in a world where capital is very mobile and where companies are operating in many countries and in the cloud. So I do think that it's an important project for the future to try to make tax systems stronger. I would only add that while this technology being developed by the private sector is revolutionary, it also may help governments do a lot better in many respects in terms of tax systems. I mean, think about trying to put in place a property tax in an emerging market or a developing country. We used to tell countries it takes 3 years to create a property cadastre, but when you've got GPS and satellites, it's better. In India and other places, having electronic technology and information technology and electronic identification may make both taxation and spending and the transmittal of benefits quicker, more efficient, and less prone to corruption. So I think that the good news here is that technology can be harnessed to improve the efficiency and effectiveness of fiscal policies, but it does have one requisite, which is that governments and legislatures are willing to provide enough resources to their revenue authorities to modernize. And for example, here in the United States, I'm not sure if it's true, but I was jokingly told that the IRS can't be hacked by cyber criminals because everything they have is in Fortran, and no one can read Fortran anymore. But the point being that there is the challenge that often it's hard for the public sector to keep up with the technologies being developed in the private sector, and that goes for tax administration as well. But there is a lot of promise in harnessing this technology.
Yeah, I think this is another major issue because we talk about these reforms in taxation, and the question is, do the revenue services have the ability, the fintech ability, to carry it forth? And that's a real question. Here in the United States, as you know, we had a delay of tax filing because the system broke down for a day. So they added one more day on. Some questions. Do we have any questions over here? We've got 5 minutes left here.
Gary Kleiman. We can't be at a Bretton Woods committee meeting and not ask about exchange rates. And I wonder whether we talked about trade wars, and one of the indirect effects is currency is on that agenda, whether it's bilateral China, TPP, NAFTA. The regional arrangements, whether they're in Latin America, Asia, currency swap lines, new entrance into the single currency in Europe has been rather dormant, I suppose, for a few years. Do you see any prospect, whether it's through the trade channel or through just the normal integration process, particularly with local currency being so popular now in emerging markets and cross-border trade and investment or for portfolio allocation. Do you see any sort of reactivation of a proactive currency coordination agenda?
I guess this is for the whole panel, so we will start with you, David, move right through.
Our view is that flexible market-determined exchange rates have served the world very well in the last 15, 20 years and through this global financial crisis. And I think we don't really see a reason to shift away from that. That's not to say everyone has to have a floating exchange rate, but that it has served many countries very well in allowing for market-determined allocation of funds and in serving as a buffer, a shock absorber when things happen. That's not to say that currencies can't be pushed away from where they ought to be. Current accounts can't be pushed away from where they ought to be. We have a whole project, our external sector report, that tries to identify, especially where imbalances and or exchange rates are pushed away from where fundamentals would have them be because of policies that need to be adjusted. But we tend to focus on getting the policies right as a principal goal.
You've been very consistent on that, David, over the years. All the time you and I have worked together and I've known you. Claire, do you have any comments on that?
No, I mean, I think the only thing I would add to it, and I hate being the banker bringing up the global financial crisis, but then you saw central banks very closely coordinate around swap lines. So I concur with David.
Look, aside from agreeing on both of those things, what I find very interesting from what David just explained on flexible exchange rates is in the larger countries in Latin America, most countries are there, but that has equally allowed us to begin to do local currency lending. And that's a derivative of this, which is extremely good for debt management for governments, but equally for how we deal with foreign exchange risk when you look at long tenors for the private sector.
We learned that out of various debt restructuring problems, right, Luis Alberto?
Absolutely.
Joachim?
Just, I think you've seen, in particular in Asia, huge amount of self-insurance, increasing reserves, Chiang Mai initiatives and the like, which are not dead. It's just that the days are sunny and reserves are high, so that's why there is not much talk about that. We see, similar to Latin America, very strong demand for local currency financing, which we as a new bank don't meet, unfortunately, yet, but would like to meet because we want to help countries manage their balance sheets and avoid that countries accumulate exchange rate mismatches for local currency generating assets. So for us, it's a very important agenda.
I've been told we have a few more minutes because our next speaker hasn't arrived, and I know, Luis Alberto, you have to leave, and I thank you very much. But if we have another question over here. Yes, the lady with her hand up. Thank you very much. Muchísimas gracias, como siempre.
Hi, this is Mia Lu from Eurasia Group. I have a question for Dr. von Amsberg. So I know AIIB was set up as a multinational development bank with green genes, but when the bank makes investments, people always view it as like Chinese money. So how would the institution convince stakeholders that it's not like Chinese money? I know it's on paper, but how to convince stakeholders and the audience that it's not Chinese money? And I will also want to further ask a question. So like for the past projects that AIIB has approved, it has been like cooperating with the peers like the World Bank Group and ADB as well. I would ask like 5 years from now, how would you see this bank like balance the Chinese color and its cooperation or relationship with its peers? Thank you.
No, thanks for asking the question. It's on many people's minds. China initiated AIIB, and that's the fact. China has been able to bring 56 other founding members on board. Those other founding members agreed to join AIIB because of two reasons. One, commitment to true multilateral governance and decision-making, and two, commitment to international project quality standards. I will repeat that here, but in the end, it's our record that has to speak to the credibility of those statements. China is now with 25% of the shareholding, our largest shareholder, followed by India, Russia, Germany, Korea, Indonesia, and so the list goes on. I think over the course of our 2 years of operations, other countries have sort of found the arrangements credible, where China is our largest shareholder, but in no way dominating the institution. Just like in other multilateral banks, there's typically a largest shareholder, but even that largest shareholder cannot impose decisions on the institution because there happen to be, and that's the beauty of multilateral institutions, there happen to be many other members who have to form a consensus on important decisions. We will increasingly be able to refer to our actual operational practice to give credibility to our multilateral governance. So just 2 numbers that may surprise you. First, we made the largest share of our loans so far to India. It happens to be the country that has demanded the most of us. There's no particular strategic direction in there, but it's certainly surprising to some. Secondly, just a few days ago, I got the numbers of which are the companies, or in which countries are the companies based who win most AIB finance procurement contracts. And I was surprised, it was Turkey. So, I mean, again, what happens in AIB is just what happens in multilateral practice. Contracts get bid out, and the best bidder wins. And I think that's the way it should be, and that's the way AIB works. And the fact that we have more than 20 new members that have joined us, countries like Canada, Belgium, and other countries, is tribute to, I think, the multilateral governance that has really worked quite well over the last couple of years. On 5 years forward, we will probably have less co-financing with multilateral banks. Right now, about 60% of our financing is jointly with World Bank, EBRD, ADB, and EIB, other multilaterals. That will probably shrink to maybe a quarter or a third, because it will be more driven by where is the need for multiple banks rather than by our still very weak staff capacity. We're 170 staff, so we cannot possibly pretend to have the capacity to help prepare structure projects all over the world in multiple sectors. So we have to very much rely on partnerships with existing institutions who have been very, very gracefully and effectively cooperating with us, so we are very thankful for that. But over time, I think we will play a larger role in the origination of projects, which MDBs typically play an important role in.
I won't ask you when the United States is going to join because...
Well, I think there are probably in this room many people who can answer that question. We can only say we are open. Our charter is very clear. AIB membership is open to any country that is a member of the Asian Development Bank or the World Bank. And of course, that includes the United States. And all countries who aren't members yet will always be welcome to join.
Thank you very much. Anyway, I think we've run out of time. I want to thank this panel, give them all a big hand, and thank David for hosting us. Thank you.